In today's video, I'm going to be talking to you about what makes a good ETF and some of the things that I look for when I'm kind of looking for a new ETF to invest in. So let's get down and let's check out a couple of different options and basically a couple of different reasons as to which ETFs I invest in. So let's check them out. So of course the golden child right now that I really like is TXF. Now why would I invest in this ETF? Well, first off, I personally really love yield. I like dividends, and it currently pays right now 11.5% for the dividend, and it gets paid out every quarter, and that is a major portion of why I would invest in an ETF. Next is the expense ratio. Now this one is a bit higher at 0.7. I generally like to have my ETFs below 0.2. However, at the same time, the growth that this has, which I'm going to get to in a bit, plus the dividend outweighs that MER by quite a bit. Next I look at is the volume, and of course the higher the volume the better. So generally, if I'm going to be buying an ETF, and let's say as an example I have the want and desire to buy, let's say, 1,000 shares of this, which would cost $21,000. Now that's that's a ton of money, but I'm just giving you an example. I would generally want to have this well over 10 to 15,000 shares traded on average every single day. So about 10 to 15 times the volume as to what you would like to invest in, or more, and you'll be all set. This is just basically the liquidity. It's how easy you can get in and out. If you want to buy 1,000 shares and yet this is only trading at 1,000 shares per day, then at that point you probably wouldn't want to invest in an ETF like that. Also, the inception date, how old the ETF is. Now that's not always the case as to why I would invest in an ETF. I've invested in ZWK, which only started a little over a year ago. However, I like to see how long the ETF's been around for, because I want to see its past history. If I see a past history where it's just continuously going down, I'm not going to invest in that ETF. I don't care how big the dividend is. I don't care how high the potential is. If it's been going down in the past and it's been going for, let's say, 10 years, then I'm not going to invest in an ETF like that. However, usually what you'll see with covered call ETFs is the fact that they usually always go down, except for a couple of these CI ETFs, and BMO ETFs generally go up, and the reason for that is they generally, and now this is not the case across all of them, but a lot of the BMO ETFs, they will do the covered calls out of the money, and they will only do it on 10% of their shares, which then allows the ETF to continuously, hopefully, go up anyways. Obviously, whatever happens in the past is no precursor as to what's going to happen in the future. However, it is a nice telling sign as to where this ETF may travel. And what we do see here is a nice climb. Of course, we know that a lot of tech companies had a couple of issues in the end of 2018, but it was able to recover quite quickly. COVID hit, which everything went down, and it was able to recover quite nicely. Now it's starting to round off. It's starting to start leveling off and trading within a range. But you know what? At the 11% dividend it currently has, and with its history of growth of going from about $12 a share to now $21 a share in about 5 years, I feel like this is a pretty good ETF if I was to invest in it, which I personally do. This is why I'm also mentioning this. I invest in it myself, so I know quite a bit about it. The other thing I like to look at is their past dividends. Now, of course, whatever happens in the past, we never know what's going to happen in the future. However, what I like to look at is generally around June. What about June over June? From 2018 to 19, the dividend went down. However, from June 2019 to 2020, we can see that the dividend went up. Now, what about March to March? Well, if we look at March to March, the dividend went up, and then if we look March to March again, the dividend pretty much stayed the same. So how I look at it here is the dividend is generally increasing over time, and that's what I really like to see. If the dividend can increase and they have a history of dividend increases, then that makes me happy and want to invest. I'm not going to invest in a ETF that generally stays the same or decreases its dividend. I generally don't like that. I also like to look at the top 10 holdings, and if it's companies that I personally would invest in one-on-one. So for example, Nvidia, I've been looking at that for forever. I've been looking at it since Facebook IPO'd, and I have never bought into it, and it makes me sad. And then Applied Materials, Alphabet, which is Google, I've been contemplating investing in them. Oracle, Intuit, Adobe, Facebook I used to invest in and I sold. I bought them at IPO, then I bought them again at 25, and I bought them again at 20, and then of course I sold them later on in the $70 range, so I did make off pretty good. Salesforce, IBM, which is the only company I disagree with in this ETF, and Microsoft. Now another good ETF now what I don't invest in is XIU. Now sometimes Yahoo will mess up with NAs, but I'll go to a different website is fine. However, what I do like to see is, of course, the gradual growth. COVID hit, and then, of course, the growth again. So over 5 years, this is a pretty solid ETF as far as the chart shows. And if you can't get your answers, you can always just go to the actual company's website that runs the ETFs. For example, iShares is BlackRock, and you can get a lot of their information. You can get their past distributions, and of course, anytime you see them slightly moving up, which we do see, it's always a good time. Now, this is an index ETF, and this one does pay 2.5% dividend, and that to me is a pretty solid number. Of course, the average PE ratio across the companies is 21, which for an index fund that seems to be pretty good. It's a TSX 60, so it's the top 60 companies in the TSX, which is going to mean that it's going to be a very stable ETF. So meanwhile, that first ETF, the tech one, is going to be just tech companies. This one is going to be an index, and it's of the broader top 60 companies in the TSX. So now with this ETF, it's a bit different than the other one, and that's why I wanted to show you this. So here we're getting an ETF that covers the top 60 companies in Canada. Now, is that a good investment strategy? Yes, because at this point, you're going to be traveling with wherever that stock market goes. And generally speaking, over the past 100 and something years, obviously we've had our times of downturns, we've had our times of stagnant growth, but overall, the market will generally travel at 5 to 8% a year higher over time. And if you want to have a nice consistent growth, plus getting a 2.5% dividend, this is a good strategy if you're a bit younger, or if you're a bit older and you don't want to have the fluctuations of an individual stock, or if you want to have the fluctuations of an individual sector, then this may be a good option. But you have to really watch out, because different ETFs, for example, SPY, which is an S&P US ETF, that one will of course be following the market, but the American market is very heavy on tech, while the Canadian market is very heavy on banks and oil and different financials. And that's why you'll see that the Canadian index funds will generally have a higher dividend percentage than the American one. And this would be the top 10 holdings of this ETF, which is XIU holds number 1 Shopify, which is tech. However, we do have many financials, and then we have industrials, which to me is also an oil play, because not necessarily Canadian Pacific, but when it comes to CNR, they do transport a lot of oil. Enbridge is, of course, oil as well, and energy in general. So, and I know they're starting to change more and more into green energy. I think that there was an article, it was either them or TransCanada, that there was an article about doing solar panels and things like that. I think it was Enbridge, but I can't remember, so don't take my word on it. Do your own research. Which leads me to my next point. Always do your own research. You can listen to all the YouTubers like myself. You can get good information, but always do your own research and see if it lines up with your investment goals. Now, one that I personally would not invest in is something like this, where it's XEI, it's the TSX Composite High Dividend. So, of course, you are getting a higher dividend, higher than what most companies will pay at 4%. And then your MER is quite low at 0.22, which is within that range where I would normally be looking to invest, and its average volume is quite high. So it seems to be pretty good. However, this is what I'm not a huge fan of. So what we see is it trading within a range for about 4 years. It traded between $20 and $22. Now it's sitting at 24. Will this mean future growth? That's really hard to say. However, whenever you see an ETF that's trading within a range, and of course it did right before coronavirus break through that range, and then it tanked obviously because of coronavirus, and it has recovered. It's having all-time highs once again, but could this be a good play? Yes. Don't take my word for it that it's not a good play. It's just something that I wouldn't invest in because I would personally rather have that 4% dividend in something that will also appreciate higher over time, and that's what I would be personally looking at over this one. I hope that this explanation gives you a couple of ideas as to how to pick your ETFs that you invest in. These are some of the qualities that I look at and that I really do value when I look at an ETF. Now, other people may say, well, I want something that's sustainable. I want something that goes and really trades with sustainable energy. Or somebody might say, hey, I want something that will be in the medical marijuana space because I really do believe in that space. Now, you can do that. HMMJ is a great option for that space. I personally use CBD for my knees. So I believe in that space, and that's why I personally invested in HMMJ, because they pay a dividend, and of course, it is a space that I do believe in and that I have very strong feelings for. So everyone has different reasons as to why they invest. I'm currently looking at a lot of different CRISPR stocks, CRISPR as in CRISPR, and those type of stocks, and of course the ARC Innovation Genomic ETF is a very good one for that, because I really do believe that CRISPR is going to allow people to live longer in the future. It's going to allow people to be able to cure cancers, diabetes, and things like that that do affect people in my family. So instead of just donating my money to some random charity that may or may not even use my money for that goal, I can just invest my money into a CRISPR stock or a CRISPR ETF that can then really do benefit those companies straight on. Of course, you don't have, in that case, the ability to write that off as a tax write-off. However, you can now benefit those companies probably a bit more than donating to a charity that pays themselves first before they pay the companies in most cases. So that's my thoughts on those, and that's what I'm looking at into the future for what I want to invest in. Anyways, I hope that this video has given you some ideas as to how to invest in the ETFs and what to look for. If it has, hit that like button, subscribe, and I'll see you guys again next time.